Hi there, everybody. Welcome to Chart This with Dave Keller. It's Tuesday, January 28th, and I am your host, Dave Keller, coming to you from a sunny, somewhat chilly Redmond, Washington. Hope you guys are all doing well, enjoying a nice upside rebound day for the major averages today as we recoup our losses, lick our wounds after Monday's sudden drop, thanks to DeepSeek AI. We're going to talk about market conditions today on the show. Obviously, a nice upside rebound after the drop yesterday. Some of the things down the most: NVDA, semiconductors, the technology sector leading the way back up. But again, sort of a flip to the script we saw yesterday. Most of the 11 S&P sectors in the red today. It sort of feels like technology on its own island, doing its own thing. The rest of the market kind of doing its own thing. And it's a push and pull between these two sort of competing themes, right? Is this market all about the AI-driven euphoria that really defined the markets through much of 2024? Or is this the beginning of some new sort of era, some new period that we will look back and define by some other, phrase or description? I think still early days to figure that out. This week, of course, we got a lot more earnings to digest. We have the Fed meeting with the latest Fed announcement coming tomorrow. A lot of things to unpack. By the way, just in the process, before we get one live here, editing up the interview I did earlier today with Peter Bookvar, which will be the latest episode on our Market Misbehavior podcast. Peter's the Chief Investment Officer at Bleakley Financial Group and editor of the book report. He's a CNBC contributor, which is how I first connected with him. And a really interesting conversation with all the different narratives we have between the Fed, earnings, the dollar, interest rates. Peter's a fantastic market strategist, great insights on economic data, on market sort of macroeconomic conditions, what sort of expectations we should have given the dollar, the interest rate environment, Trump policies, et cetera, et cetera. It was a very non-technical discussion, but I found that it complemented very well some of the conversations we've had with other guests in recent weeks. So look for that episode to drop probably later today, maybe tomorrow morning on our Market Misbehavior podcast. Recently added to all your favorite podcasting platforms. We're on Spotify, Apple, and other places. In the process of rolling out, we're about 23 episodes in with this latest one. So we'll be releasing all of those interviews over the next month on those other podcasting platforms as well. So thanks for those of you that suggested that and requested it. We're going to get to the market recap here. As a reminder, I appreciate you so much tuning in on YouTube, LinkedIn, Facebook, X, and I appreciate that very much. Those of you that are tuning in live, you have the ability to ask questions anywhere you see a comment section in any of those four platforms. That's where I can see your questions. So put them in as we go along through the course of the show today. At the end of the episode, I'll take a question or two before we wrap. And then at the end of the week, we will do an all mailbag episode where we pick some of our favorite questions we didn't get to and take a little more time thoughtfully and deliberately answering your questions. So please keep them coming. And thanks so much for the thoughtful questions you've had so far. All right. So, what was today? Today is a rebound day. I won't relate it to a rebound relationship after you have a big breakup, you have that rebound, but that is sort of what we had today, right? One thing I've learned after a big down day is it is super rare that you have another big sudden drop. I mean, yesterday, NVIDIA had the biggest drop in market cap in U.S. stock market history. So the chances of us having at least some sort of bounce higher today, pretty high. The question is how the rest of this week evolves. And, again, getting away from one day's action, sort of looking back at the overall trend. One of my favorite technical analysts, what was his name? And it's killing me that I can't come up with it off the top of my head. John Mendelson, who was with ISI, some other shops for a number of years. He was fantastic when he would come through our group at Fidelity. And he was an older man when I met him first. And he said, "I love trends you don't need your glasses to see. My own eyesight is getting less ideal as I get older, as is pretty common." And what I would suggest is literally take a step back from your monitor, take off your glasses if you wear them, and just blur it out a little bit. Think less about the little flickering tick movements and think more about the trends. That's what I think is going to help you navigate this particular period. However, let's talk about what we saw today. The Dow, the S&P, and the NASDAQ all in the green. The Dow, which was actually positive yesterday as a reminder, and still up again today, underperformed the NASDAQ, which was up 2% to 19,733 and change. The S&P closing almost a full percent higher, finishing the day just below 60, 68. and the Dow around 44,850, still up about 1/3%. So the Dow managing to have a pretty decent week this week. Sort of everything else volatile in a very volatile nature, fluctuating around large cap mixed benchmarks like the Dow. Mid caps and small caps, essentially not much change from yesterday. They were both up slightly from yesterday's close, but not much. Today was about mega cap growth stocks recovering from yesterday's wounds. Keep in mind when we get to the charts, they nowhere near recovered anywhere near the losses that we experienced yesterday. Let's keep that in mind. Although yesterday was a big down day and it feels like today was a big up day, a lot of those stocks still very much in the red from last Friday's close. The VIX moving back lower by about 1.5 points, currently around 1640. I mean, no real change in the takeaway of the VIX. I tend to think of the VIX below 20 as just a low volatility, don't worry much about it kind of environment. Even with yesterday's severe sell-off, volatility still remained in the low volatility range, below that low vol threshold of 20. A VIX above 20 is when I start to be concerned about potential anxiety-driven selling pressure. Not seeing that today, of course. The VIX coming back down as stocks recover a bit from yesterday's close. And again, we'll look at the charts of NVIDIA, semiconductors, the S&P, of course, and sort of evaluate what happened yesterday into what happened today. Looking at interest rates, I had a lot of fun with Peter Bookvar earlier today. And again, we'll get that episode out to you as soon as we can. We talked a lot about interest rates, the dollar, the Fed, and all of those things, and again, just some really thoughtful insights. Some things I had heard before, but other things that I hadn't, really stretched my thinking a bit about the interest rate environment and so forth. 10-year yields moving slightly higher today, around 4.55. The 5-year point around 4.35. Long bond yield just below 4.8%. The 10-year point, which is kind of the main interest rate benchmark that I follow, generally has been trending higher. I would argue we're in a rising rate environment over a longer period of time, although it certainly doesn't feel like that here year to date, where we've seen rates come off a little bit. I would say overall that trend in higher rates is going to be an environment that we don't just deal with today. I think we deal with for quite some time, and maybe many years and many cycles. But having said that, 10-year yield for now remaining below that long-term high of 5%. The dollar index, just not much change from yesterday. Same with bond prices. The TLT essentially flat from yesterday's close. Today was really about the recovery for technology. It also involved a decent upswing back with the commodity space, although the broad commodity ETF, the DBC, was not too much changed from yesterday. Look at gold opening higher and then just trading steadily higher through the course of the day. And this is just a great friendly reminder. I mean, I feel like for a lot of investors, you think of offense as mega cap growth. You think of defense as a precious metal, right? Something like gold, a good store of value. Day like today is a reminder that big growth stocks and gold can go up on the same time. And I always think back to a presentation by Bob Prechter, who, controversial for sure, has made some aggressive, bearish calls at times. But overall, I mean, his discussion about the behavioral nuances of investing, I think, were fascinating. And particularly the relationship between intermarket relationship studies between different asset classes. He would tell you, if you think gold goes up when stocks go down, or XYZ sector goes up because rates go down, or whatever relationship you think is true, that is an assumption, and it is not always going to be true. There are very few things in life, and certainly very few things in the investing world, where there's a relationship that is completely static, never changes, is not fluid, and is tried and true. And you just see one thing and you can bet on the opposite happening with the other. It's not that common, right? Gold and stocks move together a lot of times. Sometimes they don't. And so I would say analyzing them separately on their merits, on their technical configurations, is a much better way of thinking about things. That's what would have empowered you to own mega cap growth stocks in 2024 and also own gold, which happened to outperform mega cap growth stocks and certainly the major benchmarks for most of 2024. So think less about what should happen with something like gold. Focus on the chart itself. For now, we're right back at new all-time highs, and I did grab the chart of that to dig in a little bit further. Cryptocurrency is rolling over a little bit here, and again, you can see that from a breadth perspective, more stocks were down than up today, and so Bitcoin is following less the semiconductor group and less mega cap growth stocks and technology, but it's more following the breadth conditions of the overall market. Breadth was actually down today, and Bitcoin, Ethereum, and most of the other top 10 coins shown here were actually in the red. You can see how Bitcoin actually rolled over, was up in the 103,000 range earlier in the day, but through the equity trading session really rolled over. We're actually aiming downwards at the moment toward 100,000. We're just slightly above that level. Ether for now holding that 3,000 level. This is actually rolling over pretty aggressively here over the last 6 hours. All right, looking at the 11 S&P sectors, again, sort of the opposite of what we saw yesterday. Yesterday, the benchmarks were down, even though most sectors were up. The sector breadth was positive, as we explained on yesterday's show. Today, completely flipped that script. The benchmarks are up because some of the biggest names recovered from yesterday's sell-off. So the XLK up 2.7%, communication services up about 0.5%, consumer discretionary up slightly. Those are your three FANG sectors. The rest of the 11 S&P sectors were all in the red. Some of those defensive sectors that did well yesterday, giving back some of those gains. Staples, the worst performer, down 1.6%. Utilities and real estate, both down about 1.2 to 1.4%. So this is one of those weird environments, which happens. This happens probably more often than you'd want, where breadth and price action of the benchmarks become disconnected. And this is what happens when the mega cap stocks are so connected to the calculation of the major benchmarks, right? Stocks like NVDA are a huge weight, and the benchmark stocks like Meta and Apple and Amazon have significant weights in the S&P 500 and the NASDAQ 100. As a result, how those stocks go, so goes the benchmark. Even if the bottom 400 stocks do something different, even if 8 of the 11 sectors are down, the benchmarks are going to be up. It's not because most stocks were up. It's because a small number of the right stocks were up, the biggest names that have the biggest impact. As a reminder, though, so far for the week, still pretty much a bloodbath for technology and for other growth names, as we'll see from the charts here. We kind of regained some of yesterday's losses, but the gap that we saw on Monday's session, post DeepSeek AI being unveiled on humanity, life may be forever changed after that moment. For now, nice bounce after yesterday's drop. So today, growth over value, growth or value offense over defense, and that's sort of your three-step process here. I don't update my market trend model until Friday at the close, but given yesterday's sell-off, given today's bounce, be very keen to see if the short-term model does flip negative on some of these benchmarks. Certainly on yesterday's session, I could see the short-term model, again, which is based on weekly closing data, so I wouldn't update it formally until Friday, but you could see as things were accelerating to the downside, how that short-term model was looking closer and closer to generating a bearish conversion. You can see the cues based on what we've seen so far this week. If today was Friday's close, and if I was updating the model, the short-term model for the cues would be bearish for the first time probably since, we'll look at that chart, but December into early January was when a lot of those models were bearish in the short term. They all flicked back positive earlier in January. We'll see if that short-term model turns negative. That's usually a major top would see the short-term model turn first. For now, my market trend model is saying long and strong, fully invested, take on risk, and be happy doing so. I mentioned the breadth, and the breadth was pretty choppy at times, but overall you can see, yesterday the markets were down, but I think 7 out of 10 S&P stocks were up. Today, the opposite. The benchmarks are up, but 7 out of 10 S&P names down. This very much is a magnificent 7 as one bucket and everything else as a different bucket, and probably think of a couple buckets in there. But, overall, if you eliminate the magnificent 7, this was kind of a rough day for stocks. However, the benchmarks are dominated by the biggest names. So let's look at some of those names and how they perform today. You can see NVIDIA nicely recovering. And again, this is still nowhere near where we were as of last Friday, but having a nice 9% move to the upside. When something like what we saw yesterday happens with the big sell-off, it's going to be a volatile period as things kind of reset. And open question. I think it's still too early to really assess the impact of DeepSeek, the new AI model. And again, all of a sudden, out of nowhere, It's more popular than the ChatGPT app on the Apple Store I saw earlier today. That was quick, right? That was pretty quick, where that all of a sudden becomes the most a widely used platform, and so the ripple effects of what this means. I mean, evaluating the bull case for companies like NVIDIA, which involves spending tons and tons of billions of dollars on tons of computing power to grow these AI models, all of a sudden faced with a competitor that was a much lower cost. Supposedly, it didn't use any of those capabilities. Certainly brings the thesis into question. Yesterday, it was sort of this is the end of the AI frenzy. Today, I'm seeing headlines like, yep, that was it, and now it's fine. We can't have it both ways, right? It's either a big transformative change in the AI landscape, or it's not. And I think the market is confused as to which one of those is true. I don't know the answer either. And I would say investors certainly through yesterday and today still digesting this. I think it'll take quite some time here. It's not going to be a one-day thing. We saw the initial reaction was pretty negative. Let's see how things play out through the remainder of this week and beyond. So NVIDIA, nice recovery, up 9%. Still, I think, feeling the pain from yesterday from a technical perspective. Apple up another 3.7%. Microsoft up about 3% as well. Now, some of these names, Microsoft and others, reporting earnings this week. That'll happen through the remainder of this week. We have the Fed meeting today and tomorrow. Tomorrow's show will certainly be focused in no small part on the latest Fed meeting. In terms of the Fed, market pricing in an absolute zero chance of any change to the target rate, any change to current interest rate policy. It's going to be much more about thinking of the trajectory of further rate cuts, when we may see an additional rate cut, what that might look like. Is there any discussion about hiking rates for some reason, what that might look like? Thoughts about the latest inflation data, jobs data, et cetera, et cetera. It's going to be about that dot plot and expectations, sort of the glide path of further rate cuts, what the terminal rate may look like for the Fed funds target rate, all of those sorts of things. On the downside, Netflix, the only stock in this group that was down, and it wasn't by much. It was a couple pennies. So overall, the Mag 7 doing quite handsomely today. All right, we're going to bring up the market carpet, a heat map style visualization. As a reminder, I appreciate the questions that are starting to come in. I can't see questions on any of our live streaming platforms. So please put your questions in here. Anything that we don't get to, we'll definitely put in our mailbag and hopefully get to on Friday's all mailbag episode. Had a lot of fun last Friday going through some of the thoughtful questions that you've shared with me. Also, as a reminder, by the way, I mentioned a new episode with Peter Bookvar coming hopefully very soon. I did want to let you know I sat down with Jeff Hirsch, editor of the Stock Traders Almanac. We sat down on Thursday of last week, just released that on Monday morning. So that's the latest episode on our podcast. Had a lot of fun with Jeff talking about seasonal tendencies in Q1, outlook for a post-election year, seasonality for Bitcoin, seasonality for small caps. I mean, Jeff is really the expert that I know out of my network on seasonal tendencies. His father literally popularized the concept of seasonal trends, and the Stock Traders Almanac is a really good read every year. So make sure you tune into to that latest episode with Jeff Hirsch as well. All right, looking at the market carpet, I mean, what stands out to you? And I'm just going to kind of go stream of consciousness through this one. I mean, sort of the haves and the have-nots, right? The left third of the monitor looks pretty green. The right 2/3 of the monitor looks pretty red. I mean, neutral at best and negative at worst. So very much, again, a different vibe from what we saw yesterday, which was cover up all the big red Magnificent Seven stocks and tech names, and it looked like a pretty decent day. Today's the opposite. Of course, big move higher in NVIDIA and other names in that space, semiconductor names. Others, Broadcom, Oracle, Salesforce having nice updates today. Apple and Microsoft, two of the three biggest weights in the XLK, all having strong updates as well. You know, with technology earnings, as you sort of consume those, and if you follow earnings, which I would certainly, if you're trading individual stocks, I think you have to have at least a basic understanding of what these companies are saying and what those expectations are and how they're changing. I would be very keen on any discussion of the dollar. I think the stronger dollar in 2025, a potential risk that would hold for mega cap multinational companies making a lot of their money outside of the U.S., I think is a very real risk. Hasn't really been a huge headwind to the technology sector yet. by any strong measure. However, I think at some point companies have to address that potential, and so I would encourage you to sort of keep your ears peeled for that sort of discussion, because I think that could be an emerging theme through the course of this year for sure. So obviously a strong day for technology all around. Now, worth noting, there are plenty of names that are red in here, and before you think of technology as one sector, remember technology is not just NVIDIA, Apple, and Microsoft. I would say the XLK is very much NVIDIA, Apple, and Microsoft. Those three stocks are most of that, about a half of that ETF in terms of their market cap relative to other technology names. But if you think about it more of a bottom-up perspective, there are a lot of companies that aren't those three stocks that are also pretty big names that have potential to move for sure. And note some of these names, even though the technology sector was leading, stocks like Intel, which is kind of like a very different semiconductor than the rest of the semiconductor space, in the red. Texas Instruments down about 3.5%. Seagate Technologies down another 3% today. It's after a nice bounce higher going into this week. So it's one sort of set of things to think about. Obviously, a lot of red on the right half. It's consumer discretionary strikes me as a very diverse sector. Some sectors like energy, like real estate, like industrials in a lot of ways kind of homogenous, meaning they're and maybe financials, right? Although there are certainly some differences in terms of the types of businesses, a lot of them are tied to certain macro themes, right? So energy tied very much to crude oil. So generally the energy sector, the energy stocks tend to move together. When you look at consumer discretionary, it is sort of like the Wild West of different business models, right? You've got big consumer names, big internet companies, car manufacturers, retailers, travel and tourism, luxury retail, discount retail, kind of all mixed into one sector, home builders. So it's kind of a whole mishmash of things. And I think today's movements kind of show you how that's the case. One thing I would point out is a lot of things connected to home prices and homes in general kind of in the red today, which is an interesting emerging theme to pay attention to. Home Depot and Lowe's both down about 1.5%. Mohawk, which is a home furnishings, Pulte, NVR, some of the home builders, Lennar, all in the red today, DR Horton as well. So certainly keep in mind some of those areas of the market. The reason why I would say the other side of that is because some of the retailers are actually lights out strong. Ralph Lauren, we didn't grab that chart, but made new all-time high today, right? So there are companies that are actually in nice uptrends. We highlighted the XRT, the retail ETF, either yesterday or last week. I forget when that was, and that's legitimate. I mean, some names in the retail group are actually doing quite well. So in certain sectors, you think of them as one sort of general theme. With some sectors like consumer discretionary, I would put healthcare in there. It's quite a diverse sector, and so thinking of them as many different kind of groups of stocks within that sector, I think is a better way to probably get your head around that. Starbucks, by the way, is a name reporting earnings today. I think after the close today. We'll see if we have time to check in on that one. All right, that is it for the heat map. Let's go to the chart review. Let's go through some charts. Of course, my background and my focus in life is on technical analysis, on charts and trends. I will tell you, having done the technical analysis thing for a couple decades now, I don't think you can do it in a vacuum. I've known people in my career that look at charts and know nothing about what symbol they're looking at, and just analyze the price action. I respect their efforts to do that. For me personally, I want to understand enough about what these charts represent. And I would say they represent two things. Number one, they represent the fundamental data behind these companies. They don't actually represent the fundamental data, though, to be clear. They represent people's expectations about the future growth of those fundamental factors, to be clear. So that's one thing. And the other thing, they represent investor behavior, right? Prices move because there are more buyers than sellers, more sellers than buyers, more optimism or pessimism, or fear or greed, supply versus demand, however you want to describe that interplay between people that are doing things and anticipating the price going up and others speculating it's going to go down. That is the interplay of market participants. And I would say price, at least the argument for technical analysis, is price is the best way to reflect the overall net result of all of those participants sort of disagreeing on what's next. It comes out in price action. And so if more people are betting on the price going up, that's probably what's going to happen, right? If more people are optimistic, if more people see greater value down the road, they're going to accumulate shares and the price is going to go up. And so that's why analyzing price is so important. Now, what happened today on the S&P? So yesterday, of course, we had the big, sort of downgrade to the major stock averages with DeepSeek and et cetera, et cetera. One of the things we noted on yesterday's show was how charts like the S&P, while they opened much lower, actually traded higher through the course of the day. I think that's important to note. Question was, what happens today? Was that just one, initial bounce and then we rotate lower? Indeed, you actually saw prices continue to the upside looking at the S&P. Now, again, this is not a measure of breadth. This isn't what most stocks did. This is what the benchmark did, which is again dominated by the major growth stocks. So, again, sort of a nice risk-on day today for the indexes pushing higher. Now, things to think about. I would say the themes we've talked about going into this week are still very much there. We still have an issue where the S&P has made a new all-time high and the RSI is lower. I would say those bearish divergences are all over the place, right? You can see those bearish divergences in all sorts of places. So I would say at this point, I'm still not particularly optimistic about further upside potential for the S&P. And that's why, if you ask my upside projection, I don't really give projected levels down the road, but I would tell you I'm skeptical that the markets as defined by the S&P and the NASDAQ can go up significantly higher from this point. And that's even before we had this new AI model causing NVIDIA to be down, double-digit percents in one day. Even before that point, I would argue the upside is rather limited. I don't see how this makes it even, anything but a little less likely, to be honest with you. Having said that, the gap, almost perfectly filled today. We talked about that island reversal. Someone mentioned that in the chat on yesterday's show. Thanks again for noticing that and pointing that out. And again, that's a valid pattern until you close that gap, which we actually kind of technically did. So, see if tomorrow, if you can get back into the range of that island, which was Wednesday, Thursday, Friday of last week. There's Monday's gap, and then the trade higher. Yesterday we opened below the 50-day, but closed back above it. I think that's interesting. So today, kind of continuing that bounce off the 50-day moving average. End of the day, I usually think of price gaps as support and resistance ranges. That's why I have this green shaded area from the gap from Friday to Monday. This is why I have this green shaded area, which was the gap higher beginning of January. I would think of this market as in a congestion zone now between gap A and gap B, and we'll see which one happens first. Do we power above 6,100 on stronger momentum with the RSI pushing above and negating that bearish divergence? I would say that's very bullish. Do we break down back below 58.50, get back to retrace these lows, and the RSI goes below 40? I would say that's pretty bearish. Between those levels, if the RSI is kind of in the 40 to 60 range and we're between these two gaps, it's kind of neutral. And I would argue that's probably where we're at right now. Big downgrade to stock values yesterday, kind of a nice reaction upgrade today. Again, it's rare given the severity of yesterday's drop that you would see anything but at least a bounce higher. Today, we certainly have gotten that. Now we have the Fed and a bunch of earnings, and that is probably, I would argue, that combination of factors is what propels the market out of this range and pushes to the upside. You have to remember a lot of the technical toolkit is based on range expansion and range contraction. Bollinger Bands are based off of that idea, right? A narrowing of the bands before the break. If you're familiar with the TTM squeeze, which is John Carter created that idea. He uses Bollinger Bands and Keltner channels and combines those to look for when volatility is compressed and looking for that to expand. I feel like we're in kind of one of those volatility compression periods where we're sort of in a range, right? And the market's going that neutral direction, arguably still kind of continuing this range that we set from November and December. So I think still to be determined which way we resolve from this range. For now, I see this as a sideways, choppy, sloppy retrenchment until proven otherwise. Breadth data, of course, not particularly strong. Now today and from yesterday, today pretty good breadth, right? Yesterday you had negative breadth because a lot of stocks were down. Yesterday you had strong breadth because the benchmarks were down, but a lot of stocks actually traded higher. Today, the opposite. Breadth indicators were actually down a bit because most sectors were down. A couple of them, pretty big ones, were up. But overall, the average stock was a little bit lower today. And so what happens is, while you have the S&P, maybe making a new high, but on questionable momentum, I think we have the same problem right now with breadth. The S&Ps, broke out above 6,100 for the first time. All of the advanced decline lines based on U.S. equity data, none of those have broken above their Thanksgiving highs yet. So again, the market breaking out on weaker breadth, on weaker momentum is not bullish. Market breaking out on stronger momentum, stronger breadth, stronger volume, that's a healthy bull market phase. I can't say that we're in a healthy bull market phase at this particular moment. This feels more questionable, and I'm skeptical more than anything. Gold, and we're looking at the GLD. Full disclosure, I do own the GLD in accounts that I manage, and I will tell you that the chart of gold is compelling because it's going up. And that is the number. When I talk about gold and I get a question like, well, what's the thesis for owning gold? My answer is two things. Number one, it's going up. And so generally speaking, owning things that are going up is a pretty good investment process investment thesis, in my opinion. The second thing would be the low correlation to stocks, right? Some things have high correlation, like the S&P and the NASDAQ, right? They tend to move together. Some periods where they'll fluctuate, but there's so much overlap, they pretty much move together. So when one's up, the other one's usually up to some varying degree. Something like bond prices and bond yield, right? Prices and interest rates tend to move inversely. So if bonds trade higher, their yields go down. That's kind of how the math works out. So it's a strong negative correlation or an inverse correlation. Stocks and gold are kind of uncorrelated. So there's times when they move together. There are times when they don't. And so if you're concerned about something like the stock market, and you have a lot of investment or a lot of assets invested in stocks, something that has a low correlation, a very undefined relationship can be good, because then you can assume it's definitely not going to likely follow the path of stocks, because it usually doesn't. It usually kind of does its own thing. So from a purely technical perspective, I would say the GLD constructed because we broke above 250, which is a key resistance level. We've now cleared that gap that we saw in early November, excuse me. And now we are testing the all-time high from late October for the GLD. 257.50 or so is where we had the peak right before Halloween. You can see over the last week, we've gotten right back up to those levels. The momentum has improved. So this last push to new highs, we're actually seeing the RSI push above 60. I think that's encouraging. I mean, at this point, you're looking for a breakout on stronger momentum. I think that would be very encouraging. Back here was the last time we broke above a base on stronger momentum with the RSI becoming overbought. You also saw that here where we finally broke out to new highs. It really took a little while for the momentum to build. But again, basing patterns and then breakouts can be quite valuable. And being patient to wait for that break and then betting on trends continuing from there has worked quite well for gold in particular, and generally over the last couple of years. So, interesting setup for now, potential breakout in gold this week. We'll see. Now, NVIDIA, again, the good news is we had an up day, right? NVIDIA was up 9%. The bad news is we pretty much closed right at yesterday's high. And still, both of these days are well below Friday's close. And this is one of those things, if you pay too much attention to the daily percentage returns, and if you think of yesterday as a big down day and today as a big up day, I feel like mentally a lot of people think, well, I guess that's good. Like that was one down day, but we kind of recovered. But we just recovered to yesterday's high, right? We're still way below where we were going into last weekend with this big bearish engulfing pattern that we certainly noted. So, even though again, nice recovery day, I don't think that's a bad thing. We pushed back above the 200-day moving average after closing below it yesterday. That's all bullish. Now it's all about, do we fill that gap that we established from Friday's close to Monday's open? And I think there's still a lot of daylight above current levels before you see NVIDIA as a great opportunity. If you're a contrarian, if you're a swing trader and seeing this and betting on a short-term bounce, I don't blame you for taking that sort of a bet. Given the fact that we closed below the 200-day, we've now found support there. If that's sort of your game, I would be totally fine sort of playing this short-term upswing using the 200-day as a potential stop. If not that, using the low of this 2-bar pattern as a stop. Using the recent price action now that we have a new definition of where NVIDIA is. I think that's a good way to think about it. But do I think this changes the picture from more of a negative look after failing to get above 150, after these bearish engulfing patterns they keep popping up, and after the big gap higher on Monday? I mean, no, this just erased yesterday's range, but it's still we're still down quite a lot from Friday's close for sure. The weekly chart still looks pretty rough. All right, the semiconductor ETF, of course, a little different, right? Similar, and then you have the big gap lower with NVIDIA. Semiconductor, the SMH ETF is a little more constructive because we're actually still testing that support. So imagine if NVIDIA gapped down but was still at the lower end of that range. That's kind of what the SMH is doing here. So 235 is where this red horizontal line, it's actually around 236. That's where we're at. That was the low from early October. That lines up with a couple lows in November and in December. That lines up with kind of where we've been playing this week. Yesterday, we closed almost exactly at that support level. And then today, bouncing a bit higher. But again, today, we didn't even recover the 200-day. We did not recover yesterday's high. So I would still say this is part of a downward rotation until proven otherwise. I would want to see a bounce off of these levels, improving momentum, regaining moving average resistance. All of those things I think would be meaningful developments. Interesting that it's finding support at those previous lows. And again, from a swing trading perspective, do I get the argument for taking a shot here and betting on a bounce back into that range? I don't blame you if that's how you're approaching it. It's not how I usually trade, but I get it. For me, I'm still seeing this at best as a neutral chart, and as worst as something really potentially breaking down. I still stand by the levels we've talked about. I think the SMH pushing below 235 would be pretty negative. There's a lot of week left where that could certainly play out. Apple continuing to sort of defy the rest of the Magnificent Seven, almost moving in a very different way. I'm showing the daily chart here just to show this bounce back. We didn't technically get to the 200-day moving average, got near it earlier in the month, and now rotating back to test the 50-day moving average today. The RSI almost dead neutral at 50. You can see that the daily MACD, or the PPO, which is what I'm showing here, not quite giving a buy signal, but very, very close to doing so. Now, the reason why I wanted to show this particular chart is because we've had a number of times here over the last 2 years where Apple has sold off a bit. We've had a bit of a counter trend bounce. The PPO indicator has given a buy signal, but then it's continued to go lower. Prices continue to go lower, and you end up with these great bullish divergences. Look at that in August. This is when we've had that first buy signal in kind of third week in August. But from there, we made a series of lower lows on stronger PPO, which is sort of a bullish momentum divergence. Saw the same thing in March, April, May, where we saw the price actually make a new low on stronger PPO values. And that might, for me, looking back on the chart tells me I want to be maybe a little more skeptical of a big buy signal here, because we've gotten hurt before and we've seen how further deterioration has ended up turning into a divergence. But you're early if you're jumping in on that initial this initial signal. So while I like the bounce that we're seeing this week so far in Apple, yesterday and today, obviously a nice strong up move. Earnings coming up on Thursday, I'd probably be inclined to be patient and wait and see what happens. I would say at this point, you're kind of between some key levels. And I would say that support around 220, which is the November low, now last week's low, and the 200-day moving average. An okay chart if we hold that. I think Apple below the 200-day is a problem. That's where I have an alert set, by the way, this week. Good way to keep in with something like this, keep in mind key levels that you may want to focus in on. I'm making a note to check that alert. Pretty sure I set that yesterday, but I set a lot of them. I want to make sure I do. All right. Caterpillar, for now, unable to get above previous resistance. We've talked about infrastructure plays. I still think, through the course of this year, I think that's one of those kind of broad, secular themes that I think will be key over the next couple of years. Improvement and investment in infrastructure in the United States. A stock like Caterpillar, probably a great place to be to benefit from that. We have earnings coming up on Thursday. Monday, we gapped lower. Today, we continue to gap lower. So think of an NVIDIA gapping down, but today pushing higher. You did not see that. Today, we saw what we mentioned would be a real danger sign on the chart of NVIDIA would be further deterioration. So I think that gap range from around 400 to 405, I didn't put a shaded zone on here, but I would will definitely put it on my chart here. I would expect resistance if you get any bounce higher on that gap range. Salesforce.com. I think I have a couple more charts, and then I'll take a question or two. Boy, we're going long today. Sorry about that. A lot of charts to think about. Salesforce retesting the previous highs. This is not an earning. They reported early in December, but I like the bounce that we're seeing. 370s, the peak that you saw here. This is what we call an exhaustion gap. An exhaustion gap is where you have a big run higher, then you have kind of that last big gasp to the upside, and then you immediately rotate lower. That's called an exhaustion gap because it indicates that final push higher. We gap up on earnings, and then everyone starts selling, right? Everyone's cashing out, thrilled to not own CRM anymore. That pushed the price all the way down to around 315. We've now almost fully round tripped back to those previous levels. The RSI is overbought as we test previous highs. I think a break above 370 on stronger momentum would be very encouraging. I would also be looking at things like Chaikin money flow, accumulation distribution, some of those measures of institutional level volume as a way of confirming a potential breakout. But a chart to watch this week for sure. We'll finish off with Johnson & Johnson. Johnny John has had a nice run higher, failing to get above the 200-day moving average. Yesterday was a nice gap higher. Today, down about 1.6%, remaining in the middle of yesterday's range. That's the daily chart kind of failing to hold the 200-day. But I wanted to show you the weekly chart, and this is where I think multiple timeframes are so valuable. What's great about technical analysis, fundamental analysis, it's really hard to think in multiple timeframes, right? Because you kind of think about what the earnings trajectory is, whatever valuations you're talking about, and you look out a ways in terms of your estimates, but it's really hard to think about the short term versus the long term because I think fundamental analysis is all about the long term. Really, it's really hard to think about the short term from a fundamental perspective because there's just not a lot of data day in, day out to really define what's happening on a chart like J&J. I would say it's, on the short term, the markets are more technically driven, right? It's about how we trade around those changing expectations. Note the consistent downtrend on the weekly chart of J&J. Look at this almost perfectly defined trend channel of lower highs and lower lows. Look at this trend line connecting the major highs. So if you're buying these lows, and if you're looking for a buy signal on the weekly MACD or the weekly PPO, very close to happening. We can see the last 1, 2, 3, 4 times that's happened. We've gotten back up to that trend line's resistance. I get the argument for that. I think that's a fair bet potentially to make if that's the time frame you're kind of working on. The long-term trend, though, let's keep it in mind, it's still pretty much down, right? We're in a long-term downtrend channel that has been multiple years in the making, and I would encourage you to not overthink the short term. Make short-term decisions with short-term data, long-term decisions with long-term data. All right, we're going to get to the questions here, a question or two. As a reminder, I meant to show this earlier and I completely forgot. We've got a webcast coming up tomorrow on Wednesday, January 29th, 1 p.m. Eastern. I'll be doing a free webcast called The Morning Coffee Routine Strategies for Success. Routines are huge for me. I do a similar thing every morning called my morning coffee routine. I have a weekly routine. I have a monthly routine. I've designed these years ago and have tweaked them over time, but sticking to those investment routines has really helped me improve my consistency in terms of my analysis and my results. I'm going to share with you my morning coffee routine, talk a little bit about strategies about how you can create your own or improve your own morning coffee routine. You can sign up for that free event at marketmisbehavior.com/morning, or just scan the QR code that you see on the screen. Again, that's coming up tomorrow on Wednesday, the 29th, 1 p.m. Eastern. I hope you will join me. And let me take a question or two before we wrap. 3P Investor, thanks so much for watching. Given the current level and intensity of volatility in the market, what are your favorite trend reversal indicators, both on the upside and the downside? It's a really good question. It's sort of a broader question. And I will tell you this. I mean, number one, what's so funny is, and I've asked a number of my podcast guests some version of this question, which is, while volatility feels volatile, doesn't it? I'm surprised the VIX is at the level that it is, given the volatility that it feels like, right? I mean, while the VIX is saying we're in a low volatility environment, it feels like we're getting whipped around pretty good. And I think that could be part of the calculation of the VIX and what it's actually measuring. Maybe that's not a great measure of the swings in fear and greed and the emotional volatility that we're feeling. But it seems to me there's a disconnect right now between measures of volatility, which are telling us it's not that bad, versus what it feels like looking at the markets every day. It feels like we're getting whipped all over the place with market action. So something, and maybe that's something that develops over time. You see the VIX start to increase as charts start to reflect that. But I would agree with that it feels like there's intense volatility these days. I wouldn't disagree with you. What are my favorite trend reversal indicators? I mean, to be honest with you, in this sort of environment where there's so many competing narratives, there's so many things to think about. I think you go back to the basics. For me, analyzing the market is about analyzing trends. I do that on multiple timeframes. This is when I hold on to my market trend model like a security blanket. I wrap myself up in this, and I just sort of, hold your breath and watch these trends. All right, regardless of how it feels, regardless of how crazy things are, what are the trends? Not necessarily this is what the trends are going to be a month from now or a year from now, but what are they today? And it's worth remembering, as of Friday's close, the trends that are important to me, the long-term, multiple years, the medium-term, couple months, the short-term, couple weeks, are all positive. And so don't be too afraid to embrace that bullish construction to the market. As always, be looking for signs of a reversal. I'll tell you, I'm seeing plenty of things like breadth, momentum, divergences, bearish patterns in divergence, bearish candle patterns. All of these tell me that we're probably in the later stages of this uptrend phase, and we're probably going to see a downtrend. We're not really seeing a broad decline just yet. And so remembering that this is the market, this is, we don't get paid on what our views are. We get paid on how our positioning is. And stocks, as measured by the benchmarks, are going up. So I would say, using the moving average based market trend model that I advocate is pretty important to me. I would also say, focusing on lines in the sand, focusing on levels, setting alerts. This is a time when developing your exit strategy is really good. You're probably sitting on stocks that have done quite well over the last year. I hope you have. And if so, do what you need to do with stop losses to limit your downside if and when we start to see a major correction. That's how I would think about it. One more question, then we should be done. Dave, thanks for everything you do. Do you think communication sector will do well, considering what is happening with growth stocks? Really good question. And I would say the communication sector is kind of a mix of things. So I would say in the communication sector, you have like Meta Platforms. Is this a bullish chart? Yeah. I don't think you could describe this as anything but a bullish chart. And it's worth remembering, regardless of what I think or you think the broad markets are doing, if stocks are going up, if a chart is going up, I'm probably going to want to own it. If it's outperforming with the consistent level that Meta is, I'm going to want to own Meta, right? And so I think there are stocks in that group in that sector that are pretty good, that are at or near new all-time highs. I think those are all bullish in terms of their price action for sure. I would say the second bucket would be kind of other things, right? Like T-Mobile kind of names, media names. The communication service is actually pretty diverse. I think this is a more questionable part of the market. Things like entertainment, Disney, which I do own, could end up being a nice recovery story. I own it as a very long-term play, but and I would say the gap we saw in November, now tested and for now holding, could be a compelling setup. But this obviously looks very different than like Meta and Alphabet. And then the last one I would say would be sort of those legacy telecom names like AT&T and Verizon. We've been talking about AT&T for a while. I think it's a great chart with a strong yield, strong price action, strong dividend component. So, I think the communication services sector is actually a bunch of other, little groups kind of all meshed together. I would recognize the fact that certain areas of that sector certainly look much stronger from a technical perspective. Those would be the areas I'd probably be considering for my own portfolio. I think that's it. Folks, thank you guys so much. I can't tell you how much I appreciate you tuning in live, those of you that are doing so. I appreciate those of you watching on the replay for sure. As a reminder, we'll have our latest episodes of the podcast posted to our YouTube channel here very quickly. We are getting them out on all the podcasting platforms. So please make sure you subscribe on Spotify, Apple Podcasts, wherever you get it. It's called the Market Misbehavior Podcast. We'll be releasing a bunch of episodes over the next couple weeks, and I hope you enjoy them very much. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.